Hey, what's going on, ladies and gentlemen? I hope you all are doing well and having a great week. I'm very excited to be getting into this video as we are starting our psychology series. This will be episode 1, an introduction to trading psychology. I wanted to create this mini series to kind of touch upon all the different facets of psychology, just because psychology is one of the most underrated aspects of trading. Many people will focus on their individual strategy and continue to blow accounts and think it's the strategy that's bad. In all reality, they don't have the proper psychology in order to begin trading with any strategy whatsoever. So really everything stems down to your emotions within trading, how you deal with them, and the different facets of psychological trading that we will be discussing. So there are so many different concepts within psychology, and I'm going to be hitting on one of the major concepts here in this video is over leveraging, one of the biggest killers for traders. All right, so we are coming out with a full-on, full-force psychology course that will be made available to you all for purchase. This will be released towards the end of September 2022. But this series right here is just a little introduction to what we will be discussing more in depth within our courses. So this is nowhere near the amount of detail that we have within our psych course. We have been working on it for the past few months, and we have a lot in store for you. And I think that you guys are really going to enjoy it because really psychology is 80% of your trading. 20% is really the strategy and you being able to place trades at the right time. So understanding your mind and taking control of your mind and not letting your emotions run your trading. That seems to be the biggest problem in today's trading world. Many people will go into the markets and not have the proper psychology or the proper emotions, and they will allow outside influences to affect their trading. One of the biggest things in being able to really do anything is being able to control your mind and emotions. All right, the biggest killers for people who fail at really anything they do in life is because they can't control their emotions properly. All right, so welcome to this mini psychology series. I hope you guys enjoy this video and we'll get right into it. So understanding basic trading psychology. What is trading psychology? Essentially, trading psychology is a term that includes all of the emotions and feelings that a typical trader will encounter when trading. All right, it's that emotional roller coaster that you go through. You have your euphoria, you have your denial, you have your acceptance. It's almost like the grieving process, but for trading, right? It's that huge emotional roller coaster that trading takes you through as you're going from placing trades to managing the position to lot size placement to taking partials to exiting the position. You think about things very differently in each stage. Now, I'm going to be breaking down what this exactly looks like so you can get a better idea of how many people think about what they're doing while they're trading. All right, now I created a mini video on this a few weeks ago when I'm making this. I'm making this video today is Tuesday, September 13th, 2022. I made a little um, psychology, emotional roller coaster, if you will, type video going over this exact example, but I'm going to go over it again because I really do think it's one of the major problems that people face in their trading. It's something that if you understand how it works, you can then start to move against it. See, we are all about observing the masses and doing the opposite here at Aerial Effects. That's why we are so successful in our trading because we have to understand who is moving the market. Once we know that, then we can say, okay, well, how do they make money in doing so? Well, they have to have someone on the other side of the market for them to make money. So who are they screwing over? Well, it's everyone else. These institutions are the ones moving price. How do they make money? They have to screw over the retail traders. So they take the retail traders through this emotional roller coaster that we're about to go over. And this is like what I called in the other video, a physical representation of your mind. It's like try drawing something that is invisible, like a thought, right? So you have a thought that comes to your mind. How do you draw a thought? You wouldn't be able to perceive that because it's not something physical. Well, in the trading world, it is something physical. How the markets move are exactly how you think, right? So as we continue Along this video, you will have a clear understanding of the thought process that you're probably going through each and every day. So I'm going to go over how the markets move and what does this look like? This looks like a continuation in a bullish trend, right? A higher high and a higher low, and then looking for a higher high again. So if we take a step back and just think outside the box here, why do the markets move in such a manner? Why do we create higher highs and higher lows? Yes, it is to take liquidity. Yes, it is to mitigate. Yes, it is to fill imbalance and make the market efficient. That is true. But at the same time, it's a physical representation of everyday people's thoughts and emotions. All right, so let's first start off by talking about number one. So price is continuing to push up. So it says, the price is going up. Let's watch the market. Okay, so the retail traders had not gotten in yet. They want to see more confluence in their mind before getting in. Okay, so they're waiting. Number two, the trend is holding. I'll buy at the next consolidation. So they're thinking in the back of their minds, if price is going to consolidate next or start to pull back next, they're going to look to buy, right? So they're getting ready to buy at a more premium price. Number three, it says, I missed the consolidation, but if I wait any longer, I won't profit from the trend. Let's buy. So it's all about FOMO, fear of missing out. They need to get in thinking the trend is going to continue, that the market is going to continue pushing in their direction. This is where, indicators come into play here. A lot of traders trade with indicators, but what are indicators? They are a lagging representation of what price is doing, right? But when the indicator is telling you something, pretty much the move has already occurred because it required the move to occur before the indicator could actually update itself, right? That's why indicators don't work. And that's what retail traders are thinking on a day-to-day basis. They're thinking in terms of the lagging indicator of their mind. Essentially what that is they're waiting and waiting and waiting for so much confluence, but by that time the trend is over and then they enter, but at a premium price. Number four says, good thing I didn't wait. So the market is continuing to push up. Retail has gotten in. They're maybe in a little bit of profit. This is where the happiness or euphoria comes in for traders. I am so good at trading. Nothing could ever go against me. I'm a professional. All right, then number five says, I'll use this correction to increase my position. So they're looking at this as, okay, I was right? Because the market is pushing in my direction. We were bullish. Now price is starting to pull back. Oh, it's just a pullback. Let me get in at a better price now. So I'm going to add to my position. Number six, brilliant. At this price, let's double it. So now they're thinking, okay, well, we're getting in at an even better price. Price is pulling back and we're going to buy at the lows. Now we got to double our position because we're going to make so much money. Number seven says, ouch, as soon as it goes back up, I'm selling out. Now this is where the fear comes in. People get fearful because they're going against their position, maybe because they don't have a stop loss, or two, they got in at such a premium that when price pulls back, they're thinking, oh, okay, well, we might have a larger retracement and maybe a deeper pullback that I don't want to sustain. So maybe if price pulls back to my original entry, I'll just get out at break even. That's what they're hoping for. Number eight, I don't believe it. It's down to 8.25. It's hit its absolute bottom. So what they're thinking here is they can't believe price is moving against their original trade because in the back of their minds, they're thinking that they're always right. They have to be right in trading because it's the confirmation bias of trading. They want to build as much confluence for what they think because they're probably trading what they want to see and not what they actually see, right? The first thing on our website, if you go to it, it's trade what you see and not what you want to see. People don't understand what that means, but it's a psychological thing. All right. You have to be able to take the market at face value, take the facts, and not trade what you want to see happen. Trade what you actually see happen. So when price is pushing down, they can't believe that they were wrong, right? So as price pushes down, they think, oh, it's hit its absolute bottom. There's no way it's going to continue to push down. It has to rise eventually. I'm going to continue to hold. Number nine, okay, let's wait for it to recover. Otherwise, this will have to be a really long-term investment. So now they're getting really scared. So they get in a little bit of a fearful mindset. Now they're getting into this scared, almost panic-like state. They don't want this to turn into a really long-term investment. What does that mean? This essentially means that they have no perception of risk management. So they think that, oh, This is going to have to turn into a really long-term investment. What does that tell you? That tells you that they're going to continue to hold this position, not even caring about their risk management because they don't want to lose the trade. They're so scared of losing the trade that they would rather have it keep going into drawdown for them than to cut their losses and move on to the next one. Number 10, what are the SEC doing about this? The SEC is essentially the protection of traders. It's an organization or institution that protects um, the betterment of traders, helps them to make sure that there's no fraudulent activity going on, essentially what it is. So this is really just something that's kind of funny. It's number 10. What is the SEC doing? Meaning, why is price continuing to keep pushing down? There must be fraudulent activity. Something is going on that's not right. So price continues to fall. So they think that it's not them that's wrong, it's someone else. They have to have and put blame on other people because of what's going on. They can't ever accept responsibility for their own actions. They think it's fraudulent activity because their trade didn't go in the correct direction. Number 11, enough. I'm selling out and staying out. So number 11, they couldn't do it. They had to get out. Maybe they were close to margin call. Maybe they were just so scared that price was going to continue short that they finally said, you know what, screw it. I'm getting out. I can't deal with this any longer. More of a psychological thing than anything because they're letting their emotions get the best of them. Number 12, price is continuing to fall just a little bit. So they're like, good thing I sold everything, right? It's going to continue to fall. So I got out, at a decent price than where it is now. Number 13, it's going to tank anyway, meaning, price is starting to pull back. It's just going to keep going, right? It'll fall eventually, right? Just having a little bit of a retracement. Number 14, the told you so moment. Price starts to now continue in the opposite direction, continue to push down. So like, I told you so. I knew it all along. Number 15 says, you what? Meaning, why is price rising now? Now we're going back up to the F side. What's going on? This shouldn't be happening. Number 16, what in the world's going on here? Price is continuing to push up. It has to fall eventually, right? I have to be right because I got in at the wrong price, so I sold it. So now I think, it has to go short now because I got out. They don't want to be wrong, not only on their entry, but on their take profit as well. They want to justify every single move in the market. That is why so many people lose, is because they try to justify everything and not take it for actually what it is. So their psychology gets the best of them. Number 17, more crazies who are going to get taken to the cleaners, meaning people are getting into the market long. This person is thinking, price is going to short off because I sold it and, I knew it was going short, when price started to fall. So that's why I got out in the first place. Again, they're justifying their reasoning for getting out of the trade and selling, right? So they're thinking for number 17 that anyone who's entering into a long position is going to get screwed over because price is imminently going to fall. Well, number 18 is, this is it. I knew this was going to happen all along. So now they're going back to their original entry point. They're like, I knew it was going long. I bought it. I just didn't get in at the best price. I knew it was going to happen. So now they're trying to justify their entry again. When in number 17, they were justifying their take profit in terms of number 11 when they got out. Number 19, drat, I'll buy in again. It's cheaper than the last time. They're like, darn it, you know what? I'm just going to buy it again. It's cheaper than it was before. Now it's back time to get in because now I know it's going long. And then guess what happens? Go from 19 to number 4 again. Then price starts to correct and the whole cycle continues over and over and over again. And the retail market and the retail traders always end up giving their capital to the institutions. They always end up buying at premiums, selling at discounts, and not getting in at the best possible price because they allow their emotions to take the best of them. And they don't understand how the market actually works and how to shift their mindset to an institutional standpoint into a more professional trader standpoint in order to best benefit from the market's movements. They get in at the wrong time. See, number 12 is where I would get in. Number 4 is where I would look to short. Now, of course, in hindsight, you'd be like, well, of course you'd say that. Well, in all reality, what do we as traders look to do, especially here at Aerial Effects? We sell at premium price. We buy at discount. Who wants to buy something at a premium? You want to buy something at discount. You go to the store, right? You're always looking for deals. Deals on shoes, deals on clothes, deals on cars, deals on whatever you want. Deals, deals, deals. That's what it is. You want discounts. You want to use, whatever sort of coupon you can find, to buy something at the cheapest price. Same thing with with selling. You don't want to sell something, go to your friend and be like, hey, I'll sell you these pair of shoes for $10 when they're really worth 100, because you're going to lose money doing so. You want to sell at the best possible price you can to make the most money, right? So that's why we sell at premium, buy at discount. Now, it's like, okay, well, where is the actual discount? Where is the actual premium? How do we know if we're in premium or if we're in discount? Well, this comes down to lower and higher time frame market structure, and this is what we do teach very briefly in our YouTube videos, but more way in depth in our courses. So it's very, very important that you have a proper understanding of lower and higher time frame market structure. Multi-time frame structure is so important. That's what we pride ourselves in here at Aerial Effects, is being able to do that. And I think that's probably the major reason why we're very successful within our trades every single day, is because we understand that not only the psychology of the market, but where we need to be getting in lower and higher time frame. All right, but I'll save that for another video. Next, factors that play into trading psychology. So there's tons of factors, and I have 2 pages full of them, and I'm going to be talking about one specifically today, and we'll kind of go through some of these in the next couple of videos in the next episode of the series. But very, very briefly, you know that within this psychology course that we are coming out with, we will be divulging way deeper into it, understanding and picking apart all the nitty-gritty details in relation to each and every concept, and throwing in other concepts that you didn't even know existed into psychology that really affects how people trade. Understanding the mind is so very important when trading, and we're not only going to provide the problems and help you unravel what is actually going on in your mind and the major problems that you may not even know that you're making, but also finding solutions and giving you practical examples and practical exercises that you can do on a day-to-day basis to best fight this, I would call it, temptation or psychology that's impacting your trading, to overcome that, think differently, change your mindset, and become a better trader overall. This series is just to get you acclimated to what psychology is. I'm not going to go into all of what I just said before. That's saved for the course, but hopefully you still learn something here as well. Factors that play into trading psychology. There is revenge trading. Okay, over trading, over leveraging, which we'll be talking about today, FOMO or fear of missing out, not having a proper trading plan, setting unrealistic expectations or return goals, quantity over quality, deviating from your rules, hopping from strategy to strategy, instant gratification, and the get rich quick mentality. So let's go quickly over these. I think there's like 10 or 11 of these. Revenge trading. Essentially what revenge trading is when you're losing in the market, you want to keep trading because you want to make that money back. You're revenge trading. You're trying to get back at the market for taking your money. Over trading is when you keep placing so many positions and not being able to limit them or make them very specific or criteria based, that you keep trading and trading and trading, hoping to make more money, or maybe you just don't have a proper trading plan involved. Over leveraging is what we're going to be talking about today. It involves the really unnecessary and really inappropriate position sizing based upon your account. It's risking way too much than normal in hopes that you will make a big profit very quickly. So we'll be covering that today. FOMO, fear of missing out, just like we saw within this here. Number 2 and number 3, prices continuing to push up. They were thinking about longing the whole time, but they didn't. And now finally at number 3, they get in because they're fear of missing out. They don't want to miss out on the move. And that just creates the whole psychology market cycle here. That's what we can see. No trading plan. People don't have a plan when they come into the markets. They just trade because they think that they can make money quickly, and they don't want to take the time to actually plan the trade and plan their daily routine and plan what they're going to be doing and how they're going to be approaching the markets. They have no trading plan. Setting unrealistic expectations. This is a big problem in trading. People think that they can make 20, 30, 40, 50% a month. And when they can't do it, then they go to algorithms and they try to do that. And, just unrealistic expectations. We have very realistic expectations with our trading. 10% is a phenomenal month. We hit those definitely. We've already hit it this month. But that's because we've had a lot of great trades. Some months are not as great. But you have to be using risk management to be able to hit your proper return goals and not setting unrealistic expectations that you know that you can't hit consistently, because that's not very professional. All right, quantity over quality. People choose quantity over quality. They want as many trades as possible. I've seen it when we were originally a signal service company. When we had signals back in the day, people just wanted to get into the market. They had that euphoric feeling of being in the trade. It's just like going to Las Vegas and gambling, right? You don't care if you lose money. You just want to be involved in the gambling process. You want to be involved in the play at hand, right? Same thing for trading. They just want as many trades as possible in hopes that they'll make money. But in all reality, quality is definitely better than quantity. The quality of your trades and setups will definitely, in the long run, outperform, even in the short term, really, will outperform the quality or the quantity of the trades that you have. Deviating from your rules. When you don't stick to your rules, if you're undisciplined, you are going to lose. You need to be doing something or following your plan to the T every single time. When you start deviating and you do one thing differently than another, it's not consistent. Forex trading and most really anything you do in life, you need to be consistent with it. You need to be disciplined because it is a very routine type of thing. Trading is supposed to be boring. It's the same thing happening over and over and over again, right? It's not changing. I mean, yes, the markets do change and adapt and whatever may have you, but in all reality, if you stick to your rules and if you have a trading plan with a strategy that you know works, then you are going to be fine. We don't need to deviate in hopes that we have to catch the trade, like fear of missing out, or revenge trade to try to make the loss back. I don't care if I lose a trade because I know my strategy works. I win the majority of my trades and have great risk to reward. So when I lose, I just shrug it off and go up, along with my day, because losing is a part of the game. It's a part of trading. You can never be 100% in trading. It is impossible to do. All right, number, I think like 10 or 11, hopping from strategy to strategy. Big thing with people. They think that, if they start a strategy and it doesn't immediately work for them, they're going to have to quit and move on because it doesn't work. So they think it's the strategy that's bad. In all reality, it's just the trader who hasn't taken the time to learn the strategy and gain the experience necessary to make it work for them. Is anything good in life easy? If it were easy, everyone would be rich. And I know you probably heard that before, but it's so true. Hopping from strategy to strategy, if you keep doing that, you are just going to keep going through the cycle of starting a new strategy, trying to learn it, blowing the account. Starting a strategy, trying to learn it, blowing the account, because you keep failing and failing and failing. Failing is a part of the game. Warren Buffett, big time investor, does not invest in anyone or anything that they have not failed at least twice in. Because what do you do when you fail? You learn. It's a learning process. So when you learn what to do when you fail, you are going to be way better equipped going forward. If you haven't failed in life, you're probably not doing something right. Right? It's 100% true. If you haven't failed, what's going to happen when you do fail? I wouldn't want to invest in someone who has never failed before because they don't know what failure is like. They won't know how to respond, especially if my money is at stake. So it's the same thing for trading. Hopping from strategy to strategy, you can make a strategy work for you. Smart money, you can make it work for you. That's what we trade, obviously. Smart money is really the most logical, most applicable way of trading because it's the actual way the markets actually move in the first place. But, not to get into that we can save that for another day. But you will fail when it comes down to the strategy. You will fail with any strategy initially, but it's about building upon that and continuing to learn and gain experience over time. The biggest learner is experience. Or excuse me, the biggest teacher is experience. When you think that you can learn something instantly and be good at it and beat the financial markets within a week or a month of learning a strategy, you're just kidding yourself. Be realistic, okay? Instant gratification goes in with over leveraging. People want to make $1 million overnight. They want to make all that money. I see so many people, buying prop firm challenges right off the bat. It's like if you don't know how to trade, why are you spending your own money on prop firm challenges when there's a high probability chance that you will fail that challenge because you don't know what you're doing? It's that instant gratification. They want to feel like they're making money. They don't like the process. They don't like that they have to wait and learn. They don't like that they have to, invest in their education first. They think that, oh, well, I can get by just by watching YouTube videos and trying to do it on my own. In all reality, you can, but it's going to take a hell of a long time to do that. That's very true. I went through the same thing. I tried to do it on my own. I couldn't do it. And it's really not something that you should be doing. Finding a proper mentor is so important because they can help you through all the struggles and give you tips and advice into stuff that you should be doing and shouldn't be doing because they have done it before. So if it comes down to the money, well, then you just need to figure that out because it's just the money that's standing in the way of profitability for you. So don't have the instant gratification because in all reality, and at the end of the day, you're just going to end up losing money in the long run. It kind of ties into the get rich quick mentality here. People want to get rich quick. They want to, make $1 million overnight. They want to flip accounts. They want to do all this stuff when in all reality, it's not going to work out for them in the long term. They might flip an account to 1,000 to 10,000. Sure, you could do that. And I've seen people do it before, but if that's your philosophy in trading, if that's how you think you can approach the markets every single day, it's not realistic, it's unprofessional, and you will get humbled very quickly. So what really pisses me off about a lot of traders out there who post these ridiculous videos of them, taking 1,000 to 100,000 or 10,000 to 1,000,000 or whatever, it's not setting the right precedent for people who are trying to learn exactly how to trade the right way. It's getting them the false hope of thinking, oh, okay, I can do this consistently. If you can turn 10,000 into 1,000,000, what is that, like 10,000% return, 1,000% return? Do you think that's realistic to do every single solitary day, every week, every month, every year for the rest of your life? No. If you're going to do that and over leverage, you're going to blow your account and it's not going to teach anyone anything. So these people who create those videos, I have so much disrespect for them. I do not have respect for them at all because they're probably just trying to sell something at the end of the day. See, for me, I love PowerPoints. I'm not sitting here standing next to my Range Rover, standing next to my lake house. I'm not doing that. I'm sitting here on a computer with a PowerPoint. There's nothing in the background that shows my lifestyle. I don't like doing that because it's not helping you. It's just giving you that false hope. The reason why I like PowerPoints is because it gives you the information right in front of you. You can take notes and it's straightforward. See, that's why my students do so well is because I'm straightforward with them, because I have a plan for them. Many people just want to sell what they're doing or want to promote their lifestyle, when in all reality, that's not going to help anyone. So, that's why I do this stuff. I have a PowerPoint because I'm just trying to give you the information that you need. And that's why you're here. That's why you're watching this video today, is you want to see information. You don't want to click on a video just to see someone driving around in a Lamborghini or something. How is that going to help you? It's just going to tell you that, oh, maybe I can get that one day. And then you try a prop firm challenge, hoping that you can, pass and make $1 million, and then it doesn't work out for you, and then you quit. Right? They're selling the false dream. I'm trying to give you the information that you actually need. Next page. Treating trading as a hobby, not a business. So many people trade it as a business, or excuse me, as a hobby. It's like you really can't. You can't really do it on the side or as a hobby or just do it here and there, because you have to be all in with it. In order to make consistent money, you have to be all in with it. Now, it's not to say that you can't have a job. You can definitely have a job and do this full time. But doing it as a hobby, meaning, oh, I'll look at charts today. Oh, I don't really care about looking at charts tomorrow. If it comes around, then I'll do it. If I don't want to, then I don't. You can't do that. You have to work it into your daily routine, work it into your everyday life, and it has to be not necessarily an actual business like an LLC or a corporation, but treat it as a business. Like, you have to do it every day. You have a routine that you're constantly, trying to aim for a certain goal, right? Because that's how you build upon your skill. You can't treat trading as a hobby. It's going to humble you very quickly. You have to do it full time. It's either you're all in or you're out entirely. It's really the truth behind trading. Lack of discipline. Many people don't have the discipline, especially when they're losing. Kind of ties into psychology. Losing focus. You have to have really, really good focus. Okay, if you don't have good focus on the charts or in your personal life, it's not going to turn out well for you. So many people have that hothead mentality. Oh, I'm on a winning streak. Oh, I'm the best ever. Oh, this, and that. Again, you're going to be humbled very quickly. Fear and greed. fear of missing out, being greedy, the instant gratification, trying to make $1 million overnight, impatience. Impatience is huge. They don't want to wait. They always want to have, again, that kind of ties into instant gratification. They don't want to wait for the trade to come to them. They just want to get into the markets. They don't want to wait to, learn the material and then practice and not even have a real live account yet because you're saving your money until you're actually, you're a better trader. Impatience is what kills. Pips over percentages. Man, I've had many conversations with ridiculous people over the years. Pips do not make you money, guys. If you think pips do, you're not using good risk management. You know why I know that? Because if you're aiming for pips, what you're going to be doing is using the same lot size every time, not taking into consideration your account balance or the risk that you're using. Percentages is what makes you money. Because I could have a 10 pip stop loss and a 50 pip take profit. That's a 1 to 5. That's 5% if I risk 1%. That's 5% I make on my account. That is a specific dollar amount based upon the account balance I have. I could have a 100 pip stop loss and a 500 pip take profit. It's still a 1 to 5. You're still making 5%. It's the same dollar value. So when people say, well, I've made more pips than you, but I've made more, they say that they made more pips than me, but I've made more percentage than them. Who makes more money? I do, because I've done it the right way. Pips don't make you money, it's percentages. Getting funded too quickly. I kind of already touched base on this. A lot of people, they don't take the time to actually learn. They want to get funded really quickly. It's that instant gratification. Outside influences. Don't listen to all these ridiculous, fake gurus on social media. Social media influences you. You see so much information. It's just information overload at the end of the day, right? You're getting charts from 10 different groups, 10 different people. You don't know what's real, what's not, what's good, and what isn't. You have to focus, specialize in something. And that comes to my next one. Diversification instead of specialization. So many people diversify. They try to trade cryptos. They try to trade futures. They try to trade Forex, stocks, indices, everything. The reason why I keep saying on my live sessions, I don't trade US 30. I don't trade gold. I don't trade Bitcoin. I only trade Forex is because I'm specializing in something specific. Okay, I'm specializing. I'm learning the actual real movements of each of these pairs within Forex. Because if I looked at a billion different things, I'm not going to know. I'm going to know a billion different things, but I'm not going to know them well. But if you know a couple of things very, very well, you can make a hell of a lot of money doing that. It's a lot better. Okay, less is more. Lack of preparation, not preparing for your trade, not preparing for your life. It really just, that is a big psychological thing. The lack of preparation amongst, just everyday people. They don't prepare for anything that they do. And, for a trading wise example, they don't prepare their trading plan. They don't prepare their trades. They don't prepare their daily routine. And it just screws them over. Your personal life intervenes with your trading life. Big, big, big thing, right? If you let your personal life interfere with your trading life, then your trading life is just going to be abysmal, essentially. It's going to be nothing. If your personal life is out of whack, it's going to translate into your trading life, and that's going to be out of whack. Same thing goes, vice versa. Your trading life is out of whack. You don't know what you're doing. It's going to affect your personal life. You lose trades, you're going to get angry in your personal life. You're going to yell at your friends and family, and it's not going to go well for you, right? So, now getting into our concept of the week, the number one killer for traders is over leveraging. Essentially, over leveraging is risking an abnormal amount on a trade compared to your account balance in the hopes of making a lot of money very quickly. Guys, if you have like a $500 account, why are you throwing 1, 2, 3, 4, 5 lots on a trade? Unless you have like a 5 or 6 pip stop loss, then it's unnecessary. Right? If you have a low stop loss and it's on purpose because you're actually doing analysis and it happens to be like 5, 10 pips or whatever, then that lot size would make sense. But if you have especially for people who don't even use stop losses, if you don't use stop losses or have stop losses of like 40, 50, 60 pips, you can't really trade with high volume, and that's okay. You don't need to trade at high volume. You need to look at the risk to reward. Like I said before, even if you have a 40 pip stop loss, that doesn't mean it's a bad trade. But what if you have 120 pip take profit, right? Which is pretty reasonable for a decent sized trade. That's a 1 to 3. That's 3%. Right? That's a really good trade. So you don't need to be risking a lot to make money. If you focus on risk to reward, like for instance, this past week or over the course of the last 2 weeks, I've taken and sent out in my VIP community 5 individual AUD CAD trades. All of them were planned out. They had all the rules met. We took the trade and we make a lot of money, right? Because in the risk to rewards were good on them. 5 of them as well, 5 different positions. You only need one pair. You don't need a billion different pairs looking at a billion different markets. You don't need that. Specialize, use good risk management, focus on percentages, and you will make money, and it's going to sustain itself over the long run. And you may see someone doing better than you right now, right? Because they're over leveraging, but at the end of the day, they're going to end up losing eventually. And then you're going to be the one that's coming up on top because you were very smart and took things step by step. You were the turtle in the race. You were not the hare. Okay. You took it slow and steady. That's who's going to win the race in finance, in life, really in anything, trading, right? This leads to over trading and revenge trading. When you're over leveraging, you're more psychologically involved in the market. There's a big position at stake. Oh, if you lose, I got to make all that money back because there's no way I can sustain that loss. There's no way I can live with myself if I lost that amount of money. So they revenge trade. They place another position, not even caring about their rules or what's actually going on because they want to try to make that money back. Leads to over trading, trading more than you need to. You don't need to do that, right? Rule of thumb. So what I always say, 1% or less per trade. You don't need anything more than 1% whatsoever. I haven't risked more than 1% per trade since I first started over 4.5 years ago, almost 5 years. You don't need to. Most of the time I risk 1/4% or 0.5%. And then on some occasions that full 1%, right? You don't need more than that if your risk to reward is where it needs to be. So how do I calculate the exact position size? So many people don't know how to do this. They just place random lot sizes and don't really understand what in the world that they're actually doing. Well, so we need to focus on how do we actually calculate the position size needed based upon my account balance and based upon the risk that I'm using. So this is, where and you've probably seen this before. There's probably many different websites you can go to, but position size calculator is very simple to use. I've attached the link there. So all you have to do is type in your currency pair, the account that you are trading with. If you're in the UK, you may be trading with like pounds or something like that. But for me, I'm in the US, so I trade with USD. My account size, you type that in. Your risk ratio in percentages. I'll actually just hop over to it right here. You can just type it in on Google, my position size calculator. It's by MyFX book. It should be the first one. You see right there, first one. You click on it, comes up with this. So for instance, let's just say I'm going to pick a random pair. I'm going to trade GBP CAD. I have my account in USD. My account size, I'm just going to make this up. Let's just say 100,000. Okay, 100,000 bucks. Risk ratio. Actually, let's do it so it's realistic for everyday retail traders. So let's just go like, I don't know, $1,000. It's probably maybe what you guys are using, maybe a little more. Who knows? But anyways. Risk ratio, let's say 1%. You can also swap with money, meaning let's just say I want to risk like 50 bucks, right? I can swap with money, but usually you want to use percentages just to keep it easy. So 1%, I got to understand where your stop loss is. How many pips is your stop loss? And it doesn't matter how big or small your stop loss is. As long as you have a good risk to reward for your trade, you're fine, because that's what makes money is percentages and not pips. So let's just say, you have I'm going to make this up, a 32 pip stop loss, right? Just to make it crazy. Trade size and lots, keep that at 1. You click calculate. Then on a $1,000 account with risking 1% of your account with a 32 pip stop loss, you need to use 0.04 lots. That keeps your risk the exact same every single time, right? So if you lose 32 pips, risking 1% on a $1,000 account, you're only losing 1%, which is 10 bucks, right? Now, I know this doesn't sound like a lot, but I'm telling you, if you can't manage $1,000, you can't manage 100,000. You can't manage 1,000,000. Do it and build a habit of using good risk management every time, because if you don't, it's just going to screw you at the end of the day. Just think about it. You have a 100 grand account next. You have the same lot size, same risk. Now you can drop 4.11 lots. So this is when you need to start building your account over time. Building the habits that you need, using good risk management, practicing what professionals do. You guys need to mirror what professional traders do. Okay, so And I'm not trying to, call myself a professional trader here. I'm not trying to sound conceited, but this is why I'm creating these videos, is because through my education and my experience over the years, I've developed the understanding of all of this stuff and what is actually needed in order to be successful. Because, since I am a consistently profitable trader, I'm trying to teach you guys what you guys need to do, or what I recommend for you guys to do um, on a day-to-day basis in your trading, to help you get to the level in which I am, which is definitely, you know, is realistic. You can do that. You just need that proper mentorship as well. So, hopefully you guys understand what I'm talking about in terms of position sizing, helping you with risk management. That will definitely help you in not being that person who over leverages in your trading, and being that habit-based, routine-based person who is treating their trading like a profession, like a professional, and doing the right things in order to succeed. So guys, I hope you enjoyed this video on over leveraging and the introduction to psychology. I will be creating more videos like this in the future. This is really just a basic surface level dive of what we'll be talking about within the course. Obviously the course is way in depth. You guys are going to love it. I'm so excited to release it. There's so many cool things and features. So that'll be released probably end of this month, end of September, and we're going to make it very affordable. I want you guys to be able to afford this course, because psychology is really the number one thing that's killing traders. It's not the trading strategy. It's not them not understanding how to trade. Really, it's the all of the facets of psychology that's screwing them, and the stuff that you may not even know that you're doing. Unraveling that and having that sort of wisdom and knowledge, once you know what you don't know, it's so cool to see that and then do the opposite and then just have your trading escalate from there. It's really kind of what allowed me to, escalate my trading when I finally became profitable, starting to unravel things that I didn't know. It's just a really cool thing. So anyways, guys, as always, if you have any questions, please feel free to message me. I'd be happy to answer anything that you have, and stay tuned for the next video. Thanks so much.